that actually already is pricing in a pretty bad time, the Great Depression, unlike equities, which really aren't. So again, I think if you want to take risk in the U.S. corporate sector, and you want to take risk in your portfolio, I think doing it through the corporate bond market, and if you really want to take some risk, doing it through the high yield market is better than doing it through the equity market. The last point on bonds is to talk about treasury bonds. The government's printing a lot of those. I think there'll be about an extra $1 trillion or $2 around next year. Just remember, treasuries are risky securities. A lot of people think treasuries are not risky because the government promises to pay them back. But the economy will recover at some point in the next few years. Inflation will go up, and at that point, treasury bonds, which this morning the 10-year treasury is yielding less than 2.7%, they aren't going to be a very good deal. I think in the short run, you can own short maturity treasuries, 1, 2, 3, 4, 5-year maturity. Cash rates are going to be close to 0 next year, and those treasury bonds should probably hold their yield and give you a pretty decent return. But don't get married to them, and don't think they're risk-free, because they're not. Let me speak briefly about some of the more exotic asset classes. You can talk about commodities, you can talk about hedge funds, you can talk about private equity. Those are not really separate or independent assets. They're different ways of investing in the U.S. economy or the U.S. corporate sector or the global economy. And they're perfectly good, and in fact often can deliver very attractive returns. But don't think of them as different or separate asset classes. If the U.S. economy does well, if the U.S. equity market does well, a lot of these other so-called alternative asset classes are going to also do well. In fact, they'll probably do better. But just think of them as riskier, more volatile ways of exposing yourself to the economy, not as necessarily a way to diversify. Finally, a point that's very close to my heart, because one of the things that I was doing in addition to interest rate management was currency management, is foreign currencies. Investors all around the world have a common flaw in their approach to investing, which is something called the home bias. They like to invest close to home. Now actually, it's interesting, if you look at the data, people actually invest more in their own state relative to the whole United States than is optimal. And Americans and most other people tend to have too much of their money in the United States relative to the rest of the world. This is a great country. I think right now our policymakers are doing the best job of all, probably the major governments around the world. But nonetheless, you don't want to put all your money in one basket. You do want to diversify across markets around the world, either in your equity allocation or in your fixed income allocation. You want to make sure you have significant exposure to foreign economies and other parts of the world. I am particularly concerned about the U.S. dollar. The United States has a large amount of foreign debt. The United States is going to add hugely to the public debt over the next couple of years. The United States is going to offer 1 or 2% interest rates at best on its debt, and yet expect foreign investors, like my future employer, to continue to buy billions and billions of dollars a week of U.S. securities. That is a risk to the U.S. dollar, I think, going forward. Not necessarily in the short run, but it's a reason why it's good to have some exposure to other markets, other currencies in your portfolio for the long term. I'm going to take questions now. I'm happy to take as many questions as people have. But I want to make sure I leave things on an optimistic note. Not that things are going well now, because they're not. But this is a great country that has, I think, outstanding policymakers right now. Both the outgoing team, my former colleagues at the Fed, the people that President-elect Obama have nominated to serve him in terms of economic policy, are first-rate people. If anyone can navigate us through all of this, it is them. So you've got to play defense in the short to medium term, but in, I think, 2, 3, 4 years, things are going to look a lot better, and we'll all be happier, obviously, Thank you again for the warm welcome, and yes, I will